Well, hello everybody, and welcome to another episode of the Trusted Trustee podcast. And of course, I'm joined by Tracey Besters in the Southern Highlands. How are you, Tracey? As usual, it's fantastic to see you.
Thanks so much, Darin. I am doing particularly well today. Thank you very much.
Brilliant. That's what we like to hear. And of course, this podcast is brought to you by Superfund Property Valuations. Take the tension out of tax time by making Superfund Property Valuations your number one choice for all your SMSF property valuation requirements. Order a report today by filling in your details online at superfundpropertyvaluations.com.au and let Superfund Property Valuations take care of the hard work. And as usual, I give a shout out to Will Sparks. Will Spark, very, very pleased for his continued support. And as I keep saying, he's going to be a very busy boy as we lead up to some of these changes that we've been talking about, in particular, the Division 296
Yep.
impending implementation. And speaking of Division 296, anybody who listened in on our last podcast will know that we took you through some of the change details that dropped with the draft legislation um, when they announced it on the 19th of December last year. Very pleased about that. And but we did leave out one thing. Tracey did talk about, and we both discussed about the. It's not called a reset. It's a CGT. Uh, how do you describe it, Tracey? We're not supposed to say it's not a reset.
It's not a reset. It's an allowance for the purposes of Div 296. It's an allowance to have the cost base for the purposes of Div 296 set at the market value, not
Yes.
not the original purchase price. We call it a reset, but we're not allowed to call it a reset.
No,
So
no, in official
it's a
terms, you're not
reset,
allowed
but
to
not
say
a
reset.
reset.
So it's maybe a cost-based adjustment, if you,
Adjustment.
you want to call it that. But there was one thing that we actually left out, and
Hmm.
has something to do with SMSS who invest in unit trusts. And it's actually a pretty good point because it could have some not really nasty implications, but perhaps it's not quite as consistent as some of the other rules that have been brought down in this draft legislation. And Trace, you can talk a little bit more about that, can't you?
Yeah, definitely, Darren. And not to spend too much time on it on this podcast because literally there are kind of all of us SMSF nerds are poring over things all the time. And so there's lots of kind of, people going, oh, what about this? And what about this? And what about this? So and we could literally do that every second day. But in particular terms of this part of the measures, Darren, it's kind of like if you hold, so let's say it's property, because we're talking really about private unit trusts here. So if an SMSF has an investment in a unit trust or a private company and that company owns property, underlying asset being property, then what's going to happen with this CGT cost-based adjustment is you're not going to get the adjustment on the underlying property. And so it's a bit of an anomaly, really, because if you held the property directly, so SMSF owns the property directly, under these measures for Div 296, the super fund will be allowed to make an adjustment to the cost base of that particular property when assessing the Div 296. So it just means that you're not paying Div 296 on unrealised gains, and that's the whole purpose of this CGT cost base adjustment. But if you've got a property that's sitting in a unit trust or in a company and the super fund owns it indirectly by way of owning units or shares in those particular entities, then it's the units and the shares that get the cost base adjustment, not the underlying property itself. And so you might go, Trace, what on earth are you talking about? What that means, if in particular a unit trust, so let's say that you sell the property in the unit trust, the unit trust still has to calculate the capital gain based on sale price, less the original cost base, less any adjustments that are allowed under the tax laws, and then it will distribute whatever that capital gain is out to the super fund. The super fund will then pay tax on that, and that capital gain adjustment will be, or capital gain distribution, will form part of the earnings of the super fund. for the purposes of Div 296, you don't get a cost-based adjustment to the underlying assets, only the units themselves. So if you were to wind up the unit trust in the same year as you sold the property, you might be able to, have or minimize the impact of that capital gains coming through. But if for some reason that you sell the property in 1 year and you don't wind up the trust, or you're unable to wind up the trust until the later year, then you're not going to be able to kind of, minimize that impact of the Div 296. So not going to be it's not going to impact a whole lot of people, but there are certainly some clients. I have clients myself in this situation where we're going to be caught in the Div 296 net, and we have assets sitting inside of these other structures. So another anomaly that wasn't an oversight, this one, Darin. It was actually mentioned in the EM that they know about it and they chose to do it this way. So not an anomaly, but just a choice from Treasury.
Yeah, sneaky choice, I'd say, because they're almost
Mm.
hiding behind the second layer of investment, aren't they? So
Yeah, absolutely.
they'd say that you could reset the cost base for maybe the unit prices in the unit trust, but anything beyond that is not going to be applicable, which is, you know,
Yeah,
it's not a concession at all, really. When you consider those types of structures, it's not a concession at all. It's naturally the underlying asset that is the one that carries the value in that structure. And
exactly.
if you can't adjust the cost base for that, then yeah, as I said, a bit sneaky and inconsistent with the rest of it, but they've hidden behind like one layer of the structure in order
Yeah.
to, I suppose, justify, if you want to call it, justify the decision. But yeah, a bit sneaky for mine. But again, as you say,
Yeah,
Tracy,
definitely.
it's a conscious effort. So unfortunately, don't think that is going to change because this is one that I think, no, we just have to concede that it's going ahead.
It's there. Yeah. So the only so what I'll be discussing with my clients, Darin, is it worthwhile, or what are the ramifications and the implications if we try and collapse the trust before kind of 30 June 2027? And what does that mean? Can we collapse the trust? Can we, before we actually have an assessment or Div 296? And what do we need to take into consideration in doing that? So if we've got any listeners that are in that situation, they are going to be impacted by Div 296 and they do have property sitting in a unit trust, then make sure you have a conversation with your advisors around, well, what does that mean in terms of this CGT implication and the cost base adjustment, not reset.
Brilliant, Trace. More scenario analysis for you as
Yeah,
far as the
exactly.
296 goes. Brilliant. Everybody's going to be doing the scenario analysis now, and obviously on a changed basis than what we originally thought. But hey,
Yeah.
something to look forward to, isn't it?
Well, when you're an SMSF nerd, it's like, woohoo, let's do this analysis.
So we're not
Sad.
going to,
No.
yeah, I know. We're not going to bore you with more Div 296
No.
talk because that's what we said at the start of the last podcast is that look, we're kind of sick of talking about this, but the government just seems to perpetuate what's going on in that space. But that's the last mention of it today. We're actually going to talk about a more recent development happened last week.
5 days ago from our
Last
time,
week,
yes.
yeah, yeah.
Last week.
So I know that all of the CPI figures and the inflationary figures and the sticky situation and obviously the implication for interest rates is all bad news. But there is some good news in the superannuation world, and that is the fact that the CPI figure is so high that it would appear that the general transfer balance cap is actually going to increase as of the 1st of July. And funnily enough, even as recently as December, I wrote an article about anticipating another threshold change, but with a prediction that, or the person who was presenting predicted that the transfer balance cap would probably not change until the 1st of July 2027. So how
Yeah.
quickly things move in this world that that wasn't even 3 weeks old, 4 weeks old that
Yeah.
declaration was made, and bang,
Yeah.
there you go. changed already?
Yeah, we had a bit of a surprise with the CPI late December. So CPI rose, I think it was 3.8% in the
Yeah.
12 months to December 25 from December 24, which of course then triggers our increase to our transfer balance cap. And so, yeah, that caught us a little bit by surprise, but in a good way, finally in a good way. Happy to report more positive news. So just a reminder to everybody with what the transfer balance cap is, it's not about contributing to super. This is about when you want to actually move money, if you like, on paper from accumulation phase into retirement phase. So it's when you're ready to commence that retirement phase income stream because you've met preservation age and condition of release, you can start that income stream from super. And so it is the a limit or the cap amount of how much you can commence those income streams with. So we now have, of course, Darin, we now have five potential caps, right? So we've got the general transfer balance cap, which is currently 2 mil. It will go to $2.1 million from 1 July 2026 based on that CPI. But we've now got five potential personal transfer balance cap limits that you will have depending on when you first commenced your income stream. Talk about keeping it simple, hey?
Only five. Geez, can't we have a few more than
Five,
five?
yeah. Only five.
You
So we started
come
at
on, Canberra. Give us
I
some
know,
more.
right? Exactly. Yeah, exactly.
We've
So
at
we
least
started
got 10 fingers and 10 toes. Maybe you can get up to 20 at
yeah,
some point
yeah.
in time. You know, so yeah, uh, as you mentioned, Tracy, the one thing to really be conscious of is that we're talking about a change in the general transfer balance cap. This is where it
That's
gets
right.
a little bit complicated because
Yeah,
your personal transfer balance cap does not necessarily match the general transfer balance cap. And this is, of course, what we're talking about is there's another round of indexation that's being applied to the general transfer balance cap. But of
that's
course,
right.
how much access you have to that, and it's $100,000, how much
Yeah,
access you have to that additional $100,000 is all proportionate, and it's proportionate to how much of the transfer balance cap you have used in the past. So if you haven't used
yeah,
any, you get the full $2.1 million dollars. If
yeah,
you
that's right.
decide to use it, if you decide to start a pension with $1.6 million back in 2017 when this was introduced, you don't
Yeah.
get any benefit of the indexation at all.
No, that's exactly right, Darren. And this is what gets really confusing with this, because you're right. If when the general transfer balance cap was 1.6 and you commenced a pension, an income, retirement phase income stream for 1.6, you've got zero cap space left. You're capped out, no cap space left at that point in time. So therefore, you don't get any proportional increase of any indexation in the future. So even though we've gone from 1.6 and will be then 2.1, we've had a $500,000 increase in the transfer balance cap. You don't get any actual proportionate increase into those, into that realm. So it really comes down to understanding, well, when did you commence your income stream to start with? What was the general transfer balance cap at that point in time? Because that then starts your personal transfer balance cap. And then let's say that you started in 2017 with $800,000, not 1.6, then you've only used 50% of the cap. So you might then get 50% of any indexation moving forward. But of course, then if you then increase to 100% of the cap, then you've got zero of the future. So it's really complicated. And it's just, the administration software handles it pretty nicely. But if you want to start understanding how much of this new indexation might you get, then please make sure you speak to your accountants about that before you just go and, think that you can commence an income stream with some of this, 100K that will come onto foot at 1 July 2026.
Yeah, it's that complexity is really, for the amount of benefit that you get if they didn't apply it proportionately, I think is
Yeah,
minuscule to what they're trying to achieve and saying that, oh no, 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 you can't put that much money. We don't want you to benefit, wholly from that, and you can't put that much money in at a later date. I
yeah,
suppose the rule of thumb would be if you do know that you've got a personal transfer balance cap. So if your accountant or your advisor tells you that you've got a personal transfer balance cap, that's when you got to look out for, okay, so what does that mean? Like how much can I put in as as a result of this indexation. Because if you don't have a personal transfer balance cap, it basically means you haven't started a pension yet. So
Yeah, exactly.
you're basically off to the races as much as you can
Exactly.
be right now. But
Yes.
if you hear those words, personal transfer balance cap, then you know you've got some calculation to
Yeah.
do to figure out how
Yeah.
much interest you can get to this indexation amount.
Yeah, that's so true, Darren. And also just a reminder for anyone who has actually triggered a personal transfer balance cap, as you said, has commenced an income stream, retirement phase income stream. We're not talking transition to retirement. That isn't retirement phase.
No.
That's an accumulation phase. So we're talking account-based pension, generally will be the terminology. If you've commenced that, you can't add to that. So if you've commenced that retirement phase income stream, you can't add to that income stream. You would have to commence a brand new retirement phase income stream. So therefore, you've got to then make sure that you do meet that condition of release situation still. If you're over 65, sweet, you will be able to commence that income stream. But if you're not over 65 and you want to commence a new income stream, then you do have to make sure you can trigger that new condition of release to start that new income stream, even if you've already got an income stream. So you've got to make sure that when you commence that new income stream, that you can meet that condition of release moving forward. So again, something else to be mindful of.
Now, Trace, earlier you mentioned how we've got five wonderful thresholds that we have to take into account now for superannuation.
Yeah.
Now, one of the funny interactions is, and we'll talk about the contributions caps a little bit further on, but
Mm,
while we're talking about general transfer balance cap, it still has interaction with contributions and
yeah.
potentially your contribution strategy. It is a positive thing. I mean, it's a small concession, but it's a positive thing where
Yeah.
there's this interaction between whether or not you can make a non-concessional contribution and what the general transfer balance cap is, isn't there, Trace?
Yeah, so it's a bit of a it's an interesting correlation, Darren, because the CPI or the increase in CPI affects two main things, or multiple things, but let's just talk in this little like narrow superannuation world. It affects our transfer balance cap, the general transfer balance cap, but it also affects or impacts total super balance. So we in all of the presentations they've done, Darren, to the trustee audience, it gets really confusing when we're talking about contributions linked to total super balance, pensions linked to transfer balance cap. Transfer balance cap and total super balance are two very different things. They're in different, different realms. However, CPI increases both of them. So go figure that. So with this increase of the transfer balance cap, the 100K indexation of the transfer balance cap, we will also see an increase in total super balance as well. So what that means is we're current total super balance of $2 million. If you have more than $2 million currently today in your superannuation across the board, so not just your SMSF, but in all superannuation accounts, if you have more than $2 million, you cannot make a non-concessional contribution. So you're capped out in terms of non-concessional contributions. You can still make concessional contributions, you just can't make non-concessional. With the increase of CPI, therefore the increase in total super balance from 1 July 2026, we'll see that increase as well to $2.1 million. And therefore you might have a little bit of room to make some non-concessional contribution as well. So again, just make sure you check in with your administrators and accountants. What was your total super balance at 30 June 2026, or what will it be at 30 June 2026? Because that will determine what your contributions will be from a non-concessional perspective from 1 July onwards.
Yeah, it's quite confusing or convoluted, I suppose you could
It's
say.
convoluted, yeah.
Um, Even during our conversation right here, the number of times I've had to check myself and say transfer balance cap rather than total super balance has been a
Yeah,
number of times already, so um,
and
that's just
hopefully I
talking
haven't
about it.
said the
That's
wrong
just
way either,
talking
right?
about it,
Yeah.
right?
Yeah, so we just have to come back to, when we're contributing money, we're having to assess against our total super balance. When we're taking money out, we're assessing against our transfer balance cap. So in and out kind of. kind of process. It still doesn't make it easy, and I still say the wrong way around sometimes. So your brain kind of has this little kind of flip switch, like which way am I talking? So gets confusing. But in terms of
No,
making more contributions, Darin, our concessional contribution cap and our non-concessional contribution cap, the increases to those are not linked to CPI. The increases to those are linked to AWOTI, so the weekly on time earnings.
earnings, yes.
So those figures are due to come out. I think it's the end of February, isn't it?
Yes, yes.
Yeah. So we're expecting those to have increased sufficiently to increase the concessional cap and the non-concessional cap, but that has not yet happened. So we don't know that yet.
No, no. It is common thought that it will happen. So there's going to be an
Yes.
increase in the concessional contributions cap as of 1st of July 2026. That is yet to be confirmed, but in all likelihood, it will happen. And that's the funny thing about it. That article that I was referring to in December that I wrote, that was actually about, yeah, we do actually think the contributions caps are going to increase. And
Yeah.
the prediction was made, oh, no, don't worry about the transfer balance cap because it's unlikely to go up in the next financial year, but wait 18 months' time and it will probably go up. And as I said at the start, how quickly things change because that was only in December and
Mm.
we're here,
Beginning
which
of
is
February and it's changed. Yeah, exactly.
so if that does happen,
Mm.
the concessional contributions cap will increase from its current level of $30,000 to $32,500.
That's right. Yes, that's right. And so that means that then the non-concessional cap is linked to that. So the non-concessional is 4 times the concessional. So we'll go from 120 to 100 and what is that? $130,000 from 1 July. So if you're planning over the next kind of 5 or 6 months, and we will touch on this with some of the end of financial year planning, podcast discussions that we'll have in the future. But if you're planning to make contributions, you're planning to start an income stream, and you're looking at when to do that and how that all works, please seek some advice, before you go ahead and do that. Because at any time that we have these threshold increases or cap increases, you just want to make sure that you're maximizing the use of those increases. So, for example, if you were to use the bring forward rule, Darin, so assuming that non-concessional caps increase, which we're expecting, then you might as well, have a look at, well, can I maximize how much I'm going to get in, particularly if you are using bring forward. Currently, that would be 360,000, depending on what your total super balance threshold is at the moment. But you might be able to get, that extra kind of $30,000 in. So for some of you, you might go, well, I don't have the extra $30,000 anyway. But for others, if you're looking at, using proceeds from the sale of a property or other investment money or other savings, and you're trying to get as much money into super, just make sure that you do use these caps in the best way possible. So seek some advice before you go ahead and do it.
Yeah, it's a really important point to make from both thresholds point of view, actually.
Mm.
If you can delay starting a pension and you've got enough money to make it $2.1 million, well, why wouldn't you? Why wouldn't you just
Yeah, exactly.
take advantage of the extra $100,000? And
Exactly.
similarly with the concessional caps and more importantly the non-concessional contributions cap, if you
Yes.
can get some extra money in and you have the capacity to do so, why wouldn't you wait? I mean, that
Exactly.
that whole bring forward provision is quite powerful, but
Yes.
unfortunately, once you trigger it, you're locked in for the next 3 years. So
Absolutely.
why
Yeah.
would you get? Why would you go early? Like if
Yeah,
you can wait,
exactly.
obviously wait until the announcement has been
Of
confirmed
course.
at the end of February. We are confident. Everybody seems to be confident that it is going to happen. So
Yes.
why wouldn't you wait? Especially if that's in your plans to trigger the bring forward rules.
Yeah.
Why wouldn't you wait until after 1st of July 2026? Yeah,
Well,
makes
exactly, Darren, because literally, if you were looking at you triggering bring forward, you could literally get you could, and you haven't made any non-concessional contributions in 2026, and you haven't used a bring forward in the last 3 years. So there's a lot of, there's a lot of kind of if. You literally could do your 2026 non-concessional contribution for this year and use the 120 limit, and then you could actually trigger a bring forward on the 1st of July and use the new limit. So you could actually get just that, that extra little bit in, which of course is going to go into that concessionally taxed environment and help with your retirement savings and retirement income streams. So absolutely you would use it.
Yeah, so many layers of this onion to peel back, isn't there? And you can tell, and we've said this in the
Yeah.
past, that so many superannuation concepts are intertwined with one another.
Yeah,
So it's not
exactly.
just I look at it on the surface that, you know, I've used up my transfer balance cap, so I can't do anything. Well, actually, it does have other implications that you should be aware of because
Yes.
there are other ways that you can sort of take advantage of this rather than just, on the surface we started talking about the indexation of the transfer balance cap, but again, as you can tell, so many other implications are linked to it.
Yeah, absolutely, Darren. And I see questions all the time that come through from my clients, people that I speak with, questions in forums. And the question like might seem quite simple at face value, but it's all of the potential strategy stacks and strategy layers that you can kind of, build on to be able to get, this really amazing outcome. So you can't just say yes, no, or maybe at the face because a simple question that has a yes or a no answer might be, well, yes, but have you considered, X, Y, and Z? Because that's going to make it even more powerful for you. So it's really important to understand how all of these things interact and how they all lay together so to be able to really get that, wow output or wow outcome, which everyone wants, right? So that's what
Yeah.
makes it fun.
Absolutely. Now, speaking of the bring forward contributions, you noticed something in one of the SMSF forums that you do monitor, that there was actually a question that was raised about this, wasn't there?
Yeah,
Kind of
yeah,
about,
absolutely, Darren.
how
Yeah.
we go about taking advantage of this and can I do this?
Yeah, and I was kind of alluding to that a little bit, in the sense of there was a question that was raised on a forum that, someone has commercial property in their own names outside of super. It's worth like 300K. Can they transfer it into the super fund and make use of the bring forward contributions? And someone answered and said, yes, you can. Well, that's good. Yes, you can. However, there's all of this other stuff that you need to take into consideration. And, can you transfer it in? Well, yes, you can transfer a property in outside of super, provided it's business real property. If it's commercial and it's rented, then yes, that should be okay. But then it's around, well, how do you structure it? Do you actually structure it as all non-concessional contributions? Is there going to be a capital gain on that particular transfer of that property from your own name to the super fund? Because that's something you've got to take into consideration. And, if you're triggering a capital gain, then you might actually need a contribution, a concessional contribution to help minimize the amount of capital gains tax. Then you're going to have a look at, well, should I use some catch-up concessional contributions? Is my total super balance below 500,000? Should I use some of that to minimize the capital gains tax? Maybe you don't have any capital gains tax at all to worry about, so therefore you might just go straight down the bring forward non-concessional contribution rules. So we kind of sometimes hear these catchphrases and we listen to podcasts or we read something and we kind of take on board a little bit of some of the jargon that's mentioned or some of the concepts that are mentioned, but you've just really got to work through every single piece just to make sure that you're getting, like I said before, that wow outcome.
Yeah, and the contributions piece is so important because,
Yeah.
again, why not
Yep.
maximize how much money you can put into your super fund? And a lot of people actually do forget. I know this language is confusing as well. They call it the carry forward
Yes.
unused concessional cap. And a lot of people actually
Yeah.
forget about that. But I would actually argue that most superannuants in Australia don't max out their concessional contributions cap. So
Mm.
you've not only got the unused part, but you can carry that forward for a 5-year period. So you can look back at that and if it means that you're absolutely maximizing how much you can get into super, well, why not do it? Because,
Yeah,
it's
exactly.
ultimately going to benefit you. And particularly with the concessional caps, because you get a tax deduction out of it as well, you know?
Exactly, Dan. Exactly. And then all of that, then you've got to then think about flowing through to, well, how old are the members of the fund anyway? And if they're, if they're kind of at their later years in life, then you really want to then factor into, well, the estate planning issue, and then what happens when the asset has to come back out, right? Because if the asset has to come back out in the next 5 to 10 years, for example, then we may, you may be thinking, well, we want to build up tax-free money, not taxable money. So although we've got a capital gain now and the concessional contributions will help now, it will actually put taxable money into or taxable component into the super fund as opposed to the non-concessional, which will put tax-free components in. So you really, it's really not just a one step set and forget kind of strategy when you're talking about, pushing things into super. You've got to be really cognizant about well, what does it look like big picture, and what am I trying to achieve big picture? So really important to get that advice from someone that does understand how all of these things kind of interact. It's not just a chat GPT question and answer. When it comes to self-managed super funds, you've got to kind of really think through all of the process.
Yeah, absolutely. And I'm going to go into bat for all of the technical specialists like Tracy and practitioners I know who stand up in front of these audiences and they get fired questions, just like the one that you highlighted out
Mm.
of that SMSF forum. And it may be a little bit frustrating. I know that this has happened several times at our trustee events that somebody asks a question, and the favorite answer seems to be, well, that depends.
It depends. Yeah.
I know that on the surface that might be, well, what are you talking about? I want to know whether or not I can do it or not. But what Tracy just went through with the whole putting the commercial property into super and maybe taking advantage of the bring forward non-concessional contributions rules. Well, it actually depends. Yeah, you can do it when, the answer is yeah, you can do it, but it
Yeah.
depends whether or not you want to do it like that, which is why it
Yeah.
depends. But that I reckon is the favorite answer
It
when people
really
get
is.
asked about strategies. It doesn't matter what strategy actually. 9 times out of 10, the answer will be, well, it depends.
Absolutely, Darren. And I think that sometimes I'm sure sometimes the attendees or those who are listening will kind of think it's a very flippant answer for us to give. It depends because they're like, oh, they just don't want to tell me the answer. Well, actually, that's not true. We really want to help. Um, Sometimes it does depend because there is a whole lot of questions that we don't know and a whole lot of answers to questions that we have to, elicit to be able to know what the actual, step by step should be. So please be mindful of that when you're asking questions of us.
Yeah, it won't surprise people that I think the first person who I heard say it depends was actually a lawyer presenting in the
Yeah, of
space.
course.
You know, what do you say to that? Pretty obvious.
Exactly. Exactly.
Anyway,
Exactly.
we've run out of time, Trace,
Of
as
course.
usual.
Of course.
So just wanted to thank you for your time of taking us through those sorts of things. What a win. This is okay, we're marking them off as we go. So we're not stumped at the end of the year. I'm gonna put this in another winner winner chicken dinner category.
Definitely. This is definitely in the winner winner chicken dinner category. 100%.
So we've chalked up a couple of already for 2026. There's going to be plenty more as we go through these podcasts. But yeah, as I said, thanks Tracy for your time and for taking us through those important issues.
My pleasure, Darren. Look forward to the next one.
Thanks also to Super Fund Property Valuations for their continued support. Thank you very much to my production team who put this all together and make sure our podcasts are published on all of our different channels and streams. Just a reminder, if you're enjoying our content on YouTube, please remember to absolutely smash that like button and hit the subscribe button as well. And of course, most importantly, thank you to all of you for joining us for another episode of the Trusted Trustee podcast. Again, I always say we hope you enjoyed it listening to it as much as we enjoy bringing it to you. And more importantly, we hope that you've got some valuable information about running your SMSF. So until next time, thanks again for your company. Travel safely, and we'll see you for the next episode.
See you soon.